Hey, what's up guys? I am 19 years old and today I'm pulling back the curtains on my investment portfolio. No flashy cars, no designer clothes, just smart money moves that actually make sense. So, are you ready to see what's actually in my portfolio? Well, not everything just yet. Before we dive in, let me give you some context on why I started investing at 19 in the first place. Honestly, I realize most people my age are just spending without thinking ahead, and I wanted to do the opposite, make smart moves now. Even small steps, if you start early, can turn into something huge over time. That mindset is exactly what shaped my portfolio, and now I'm about to show you what's in there and why I picked each investment. Alright, let's go back to the beginning. My very first investment I started in September 23rd, 2025. And even though it was small, it taught me a ton about picking the right moves and staying consistent. The very first investment I ever made was VOO, the Vanguard S&P 500 ETF. VOO is an index fund that tracks the S&P 500, which includes 500 of the largest publicly trading companies in the United States. So instead of trying to pick one stock and hope I choose a winner, I'm investing in the top companies across the entire US economy. When I buy VOO, I automatically own small pieces of companies like Apple, Microsoft, Amazon, Nvidia, Google, all in one investment. And that's exactly why I choose it. At 19, I understand that picking a single stock is risky. If that one company struggles, my investments struggle with it. But with VOO, my risk is spread across 500 companies. If one underperforms, others can balance it out. It's called diversification, and it's only one of the most important principles in investing. VOO is also low cost, simple, and historically the S&P 500 has averaged around 8 to 10% per year over a long term. The kind of steady compounding over decades is powerful. I'm not trying to get rich overnight, I'm building a foundation. At 19, time is my biggest asset, and this is how I'm using it. My next investment will be QQQ. I already like VOO because it's given me a simple way to own a lot of big US companies at once. It's more balanced and steady. QQQ is a little different. It focuses more on big tech and fast growing companies. So instead of being spread out across everything, it leans more into technology. You still get companies like Apple and Microsoft, but they matter a lot more in QQQ. And you also get other big tech names too. Because of that, QQQ can go up faster when tech is doing well, but it can also drop faster when tech is down. So I see it as more of a growth type investment, while VOO is more of my steady long term base. Now, one thing to keep in mind is there is some overlapping between VOO and QQQ. They both include a lot of the same big name companies like Apple and Microsoft. So you're not getting completely different investments here, but the difference is how much weight those companies have in QQQ. Tech companies make up a much bigger portion, so they have more influence on how it performs. For me, that overlap isn't really a problem. I see it as putting a little extra focus on the companies and sectors I believe will grow the most over time. I believe tech is the future, but if I have to readjust my portfolio and get QQ out of there, I will. S&P 500 will be in my portfolio for life. Next up is SCHD. I've already covered VOO and QQQ, and this one's a little different from those. I know SCHD isn't usually what people recommend for someone my age, and I get that. A lot of people say just focus on pure growth when you're young. And yeah, I'm still learning, so I'm always open to adjusting things over time. But the reason I invest in SCHD is because of the quality. It focuses on companies with strong cash flow, solid balance sheets, and a history of growing their dividends. That's exactly what SCHD is built around. It's not about chasing the highest yield, it's about investing in high quality companies that can consistently pay and grow those dividends over time. So, if you're looking for something combine income with long term stability, SCHD is definitely one to keep on your radar because at the end of the day, it's not just about getting paid today, it's about getting paid more over time. Now, the next part of my portfolio shifts away from just the US entirely because no matter how strong one country is, I don't want my long-term future tied to the single economy. That's where VXUS comes in. VXUS gives you exposure to international markets outside the United States. That include developed countries like Europe and Japan, as well as emerging markets that still have massive long-term growth potential ahead of them. And the idea behind it is pretty simple. Different parts of the world don't move in sync. It also adds something really important to a portfolio that a lot of people overlook: balance. Because if everything you invest is tied to one economy, one currency, and one market cycle, you're taking a lot of risk than you might realize. VXUS helps solve that by spreading your exposure globally. It's not about betting against the US, and it's not about picking winners or losers between countries. It's about making sure your money is positioned in multiple areas of the world at the same time. So, while some investments focus on specific sectors or income strategies, VXUS is really about broad diversification, owning global growth in one simple holding. Now, I want to talk about one of my individual stock picks, Netflix. Netflix is one of the largest streaming platforms in the world. Most people know it for movies and TV shows, but it also expands into live content and sports. The reason I invest in Netflix is because I think the company is still evolving. Even though it's already a mature business right now, Netflix is trying to move beyond just on-demand streaming. They're adding live programming, comedy specials, and sport content. Sports is especially important because it creates consistent live viewership and helps improve subscriber retention. They've also made some important changes in their business model, like introducing ad-supported plans and tightening rules around password sharing. While those changes were controversial, they focused on improving revenue per user and strengthening long-term profitability. So, I don't view Netflix as a high-growth tech stock anymore. I see it as a mature company that's still finding new ways to grow and stay relevant. Competition is still a major factor. Companies like Disney, Amazon, and Apple are all heavily invested in streaming. At the same time, content costs, especially for sports and premium shows, remain very high. So for me, this is a calculated position in my portfolio. It's not the safest investment, but it's a strong established company that I believe is still adapting well. I started building my position when the stock was near its COVID era lows, and I've been continue adding it over time. I'm not necessarily treating it as a forever hold, more of a multi-year investment where I want to see how the company executes. At the end of the day, Netflix is already a leader in its space. The key question is whether it can continue adapting as the streaming industry becomes more competitive. So, that's my portfolio. I'm 19, just starting out, and this is the beginning of me building and tracking my investments over time. I've got a mix of long-term ETFs for stability and individual stocks where I'm taking a bit more risk and trying to build upside. I'm not trying to time anything or get everything perfect. I'm just focused on staying consistent, learning as I go, and letting everything compound over time. Appreciate you all for watching. Make sure you like and subscribe, and I'll see you guys in the next one.